Okay, well, let's go ahead and get started now. I want to say hello to everyone and thank you for joining me this evening. Well, we're going to have an hour presentation tonight concerning the stimulus provisions related to the COVID-19 updates that have happened recently. So my name is John Jennings, and I'm happy to be part of the event number 7 in Cognitive Behavior Institute's private practice series. And as I said, today we're going to talk about some of the more relevant COVID-19 stimulus provisions. So just a quick background. I've been a CPA for over 20 years. I have a master's degree in taxation, and my experience has spanned public accounting and serving as the chief financial officer of several large, closely held organizations. So I launched my firm about 12 years ago, and we specialize in serving owner operated businesses. So, as far as the housekeeping matters go, I'm going to ask everyone to please keep your microphones muted during the presentation. And if you have any questions, I'm going to ask you to hold them until the end and then type them into the chat box. And we should have enough time to get through some questions here at the end, and I will try to answer as many as I can. And I've also provided my email address, so if we go through this and you don't have an opportunity, or I don't have an opportunity to respond to your question, feel free to email me and I will get back to you probably within a day or so, hopefully as quick as possible. Now, one thing that I do have to say is the rules that are out there and the things that we're going to talk about today um, are very hold on one second. Let me just make sure. Let me just make sure that the screen sharing is working. Okay, I believe it is. Yeah. Um, so anyhow, the rules that we're going to talk about today are very complicated, and there's also been a huge amount of conflicting guidance that's been put out by the Treasury Department, by the SBA, and where I think it's appropriate, I'm going to try to point out some of those contradictions to you. But in many areas, all of even though there may be some conflicts out there, it seems like the trend among all the professionals are that their interpretation is going to stand. So again, let's hit the disclaimer here. And as I said, today's presentation is not intended to provide any accounting, legal, or professional advice. We're really looking to raise your awareness of these topics. And as I started to say, the topics are complicated, and the guidance is continuing to evolve continuously on these matters. So let's jump into specifically what we are going to cover today. So we're going to talk about the economic injury disaster loans and emergency economic injury grants, and that's the traditional EIDL program, and you'll hear about that when there's a natural disaster, a hurricane, a flood, a tornado, things like that. And that is also applicable to businesses impacted by the coronavirus outbreak. We're also going to talk specifically about the Coronavirus Aid, Relief, and Economic Stimulus Act, also known as the CARES Act. And specifically within that act, we're going to talk about the Paycheck Protection Program. We're going to talk about a number of tax provisions and really hit on some of the key ones that I think would be most applicable to your businesses, specifically the individual tax rebates, use of retirement funds, some charitable contribution changes, individual business losses, and how those can be carried forward or backwards, the employee retention credits, employer payroll tax payments, net operating losses, the business interest deduction limitations, qualified improvement property, and corporate AMT. So as you'll see, we have a pretty full agenda here, but again, many of these topics I want to present to you at a high level. I did make the slides rather detailed because that's one thing that I always hate when I sit through a webinar is I get slides that are so general in discussion. They're rather worthless without the commentary to them. So so I tried to make these detailed, but obviously we'll try to move through them as quickly as possible. A couple things that we're definitely not going to cover today is the Families First Coronavirus Response Act and the Pandemic Unemployment Assistance. So I really wanted to point out the Families First Coronavirus Response Act because if you have employees, you really want to make sure that you and your advisors are on top of your responsibilities under that program. And that's the program that provides for the Emergency Paid Sick Leave and the Emergency Family and Medical Leave Expansion Act. So if you have if you are an employer and have employees, you really have a number of responsibilities, both with the Internal Revenue Service and the Department of Labor. So I'm just going to ask you to be cognizant of that should that fit your description. So let's jump right into the economic injury disaster loans. And these are the EIDL loans. They're the traditional disaster loans that are available for a wide range of disasters. Now, one of the important things in a case of coronavirus is that the SBA has lifted the normal requirement that you have to have physical damage to your facilities and in your business and use part of the funds available to repair that damage. So this program, it's a low interest loan of up to $2 million with an emergency advance of up to $10,000. So businesses with less than 500 employees and all 50 states are eligible. So because the disaster declarations have covered all 50 states, anybody in any of those states can apply. The basic rules are the business must have been in operation since January 31st, 2020. It includes sole proprietorships and independent contractors. And as I said, it eliminates the physical damage requirement traditionally associated with these loans. If you were to seek out an EIDL loan and grant, it would not preclude you from taking a Paycheck Protection Program loan, but the proceeds, you couldn't use the same expenditures to count for the EIDL loan and count for the Paycheck Protection loan. And EIDL loans can actually be refinanced into the Paycheck Protection loan. So we're going to talk about the Paycheck Protection loan in the next slide, but just be aware that's the hot topic that everybody's talking about now. The emergency and injury economic grants and disaster loans, those are more traditional loans. The interest rate is at 3.75%. They do require the businesses to be able to repay the loan. They force borrowers to certify that there's no other source of funds that could be used, and it's just a more traditional disaster loan. So those loans can actually be obtained through the SBA website, and the SBA actually had a banner at the top of their website that you can click right on to get started. So let's talk now about the Paycheck Protection Program. And this is the program that really was generating all the excitement out there. You saw it on every newscast you tuned into, and this was the bailout program for the small businesses. Well, as of this afternoon, the program's out of money. So I was actually really hoping that I was going to be able to tell you all today that the program, the funding has been reinstated and everything is moving forward. But unfortunately, I just have not been able to get that word yet. So the program was initially set up as a $349 billion program aimed at providing liquidity to small businesses. It has very favorable terms, no credit or collateral requirements, what was supposed to be a streamlined application process. And this is the real kicker to the loan is if you use it for certain expenditures, you can actually have the loan forgiven and receive completely tax-free income from this loan. And it's actually, it's just an amazing program if you can get in and if you can qualify for it. So as I said, the program currently is out of money. From everything I've heard, everyone at the Treasury, in the administration, and in Congress wants to refill the coffers, if you will, and get more money into the program. But like anything, it's a matter of actually getting that done. So make sure you watch the news and stay tuned for more on this. Now, with that said, I think it's still important to cover it here. It's a very complicated program. There's been incredible inconsistencies in the guidance that has been released. There's areas here that the rules provided by the Small Business Administration conflict with the actual language in the laws, and the Treasury Department has also stepped in and kind of streamlined some things that weren't clear in the law, and actually seem to have made some requirements that that maybe didn't exist in the initial legislation. So with that said, I have several clients that have been approved for funding, and they were able to get in before the end of this deadline. I also have several clients who have filed applications and who were desperately seeking these funds, but are afraid that their applications didn't make it through the bank's due diligence check, if you will, before they were submitted to the SBA, and they're concerned that they are not going to see any funding from the program. So the reason I point that out is in this law and in the government's desire to roll this program out quickly to the businesses, it made the banks the gatekeeper, the watchdog, the responsible party, if you will, to get these loans and get the required documentation and get them processed. Unfortunately, this was done in such a haste that there's actually there's conflicting information in the rules that were written by the SBA. There's areas that are really open to broad interpretation that don't have any guidance or regulations issued yet. So it's an area that's caused a lot of confusion. But even through all this confusion, there's been $349 billion appropriated, if you will. So how did that happen? And this is one thing I caution everybody, that if this program opens back up, be sure that you know your banker and you have a good relationship with that banker. Some banks have come right out and told their clients that they would not be accepting applications for this program for anyone other than people that had a current business relationship with them. There are other banks out there that were not that forthcoming with their clients, and they simply took all the applications they could get, but they processed them. They gave priority processing, if you will, to their preferred clients. And there was actually a recent decision handed down, I believe it was yesterday, and forgive me, I might be wrong here, if it was either Bank of America or Citibank, but one of the large bankers actually received, a positive judgment that they were within their rights um, to prioritize their clients and not necessarily process loan applications on a first come, first served basis. So I just caution everybody out there, because I know just from what I've seen with clients that deal with multiple banks and multiple clients working with the same bank but in different situations, that there's a wide um, there's a wide range of cooperation out there, and assistance from different banks and different bankers. So let's get into the requirements, and then we can kind of fill in all the backstory as we go. So basically, what we're going to talk about is who's eligible for the program, how much can be borrowed, how can you use the funds, how much of this loan can actually be forgiven, and how to apply and what to expect through the program. So the basic loan provisions are that it's a 2-year loan at 1% interest. Now, the original law called for a 10-year loan at no more than 4% interest. The SBA, when they originally rolled out the plan, it was a 2-year loan at a 0.5% interest, but the banks actually pushed back and said that 0.5% interest made their other products look so unattractive that they weren't going to offer the loans because of that. So through negotiation, and it ended up being a 2-year loan at 1% interest. As I said, qualifying amounts can be forgiven. The loans are completely non-recourse, provided that they're used for qualified purposes. And you have to be careful, because in a loan application, there are some certifications that the borrower has to make. And it's easy to just kind of read it like the fine print on the back of a credit card statement. But you really, if you're going to sign the application, you need to be aware of what you're signing up for. And because the Treasury Department and the SBA have both announced that they will be pursuing fraud charges for anyone that they feel has taken a loan fraudulently or used it incorrectly. But again, it's non-recourse as long as it's used for qualified purposes. No personal guarantee, no collateral, no credit worthiness, no need to verify that you couldn't obtain funding from some other source. It's really a government-backed loan made to inject money into businesses and really get that money to stimulate payroll and stimulate the economy. No prepayment penalties, as I said, and the loan applications I mentioned above, could require some specific certifications that you'll want to make sure you review closely with your advisors. So, who's eligible? There was a little bit of confusion about this, and maybe not so much confusion, but maybe a little unfairness, if you will, as to how it was rolled out. But the loan is eligible for borrowers that pay salaries or pay independent contractors on Form 1099 miscellaneous. So the borrower must have less than 500 employees. If you're a franchisee, there's special rules that apply. And if you own more than one business, there's special affiliated group rules that apply. But when the program was rolled out, those businesses got a weak head start on being able to apply for this money over the sole proprietors, independent contractors, and other self-employed individuals. So those people are eligible if you have your own practice and you're operating it as a sole proprietorship, a single member LLC, as a contractor for a larger practice. You are eligible to apply for these loans, but you were required to get a little bit of a late start on it. So let's talk about how much you can borrow. So for a typical wage paying borrower, the loan is the maximum amount of the loan is calculated at 2.5 times the borrower's average monthly payroll cost up to $10 million. The average monthly payroll cost may be based on your 2019 calendar year payroll, or it may be based on the payroll from the most recent 12 months. Now, uh, early on in the applications, there was a huge amount of confusion and variance over this provision from bank to bank. That has since been cleared up, and there's actually been a rule published that gives the borrower the option to compare, the 2019 annual payroll and the most recent 12 months up to the date of the loan, and actually pick whichever period works in their favor. Um, so payroll costs include your typical salaries, wages, commissions, and also you get to include company payments for health insurance, retirement benefits, and state taxes paid on payroll. Now, here's another area of huge confusion when this thing started, but payments to 1099 contractors should not be included in your payroll calculation. And I know that I have some clients that had submitted applications with those amounts included directly at at the direction of the bank, because there was so much confusion over this provision early on. And we're really just waiting. We kind of have our fingers crossed to hope that those clients, their loan applications did go through and get through to the SBA, but there may be some actual adjustments to the amount that can be borrowed before the loan is actually closed. So we have to keep our eyes or keep our ears open for that. For self-employed individuals, they go through a long litany, if you will, of how to calculate what amount would be available for the loan. But basically, when you boil it all down, self-employed individuals, their loan calculation is based on self-employment income. So payroll does not include compensation in excess of $100,000 per employee, compensation paid to employees whose principal residence is outside of the U.S., and compensation paid under the Families First Coronavirus Response Act. And if you'll remember, that's the one I said early on. If you have employees, make sure you're aware of it, because there is some provisions that employers are responsible for paying enhanced FMLA and enhanced sick leave, and those wages don't qualify for the loan amounts under this program. And there's reasons for that. They're actually covered by a different set of credits that we're not going to get into today. So, as I said, the SBA has released some conflicting guidance throughout this process, and the last bullet here is one that was just particularly striking. In the law itself, the law clearly states that for the purpose of determining payroll, you're not to include federal income tax withheld or payroll taxes withheld from the employees And I don't know the reason for that. My thoughts are the government probably didn't want to make a forgivable loan that paid money out that was really the taxes that was withheld on the money that was originally paid as payroll. But the SBA provided guidance and specifically said that even though they understood that this was in conflict with the legislation, the payroll calculation should be based on gross payroll, including federal income taxes withheld and including employee, withheld payroll taxes. And I think their idea was that they were trying to simplify the process. So that's basically how you come up with a calculation of how much you can get. It's basically the average payroll, the average monthly payroll multiplied by 2.5, and that's the amount available under the loan. So how can you actually use the funds? So the law requires certain specific things to be used, or to be, the funds to be used for, and it's not just a general purpose loan that you can do anything you want with. And specifically, it has to be used for employee compensation and payroll costs, group health care benefits, mortgage interest, rent, utilities, and interest incurred on debts incurred before February 15th, 2020. The SBA has announced that unauthorized uses will be required to be repaid and may be subject to fraud prosecution. So they're really looking at these, and they see the intent of this legislation is to keep employees paid and to keep payroll flowing through the system, have the workforce ready to go as soon as the coronavirus restrictions are lifted. So I think that's why there is such a caution out there of make sure that you use the money for its intended purposes, or you could be subject to fraud prosecution and so forth. So the real benefit of this loan, I mean, first of all, it's just amazing to see a loan product with a 1% interest rate, with no credit checks, no personal guarantees, no collateral, and just the very favorable terms that there are to begin with. But then on top of that, there's actually the opportunity to have loans forgiven as long as the proceeds are used for qualified purposes. So qualified costs let me say this, qualifying costs that are paid during the 8-week period beginning on the date of loan origination may be forgiven. So what are qualifying costs? Basically, they're payroll costs not in excess of $100,000 per employee. Their payments towards health and retirement benefits, their mortgage payments on real estate or personal property. And I'm going to skip these dates going forward, but for the next 3 items, just understand that if you're paying mortgage payments, rent, or utility payments, the service had to be in effect. The lease agreement had to be created. It had to be things that happened before February 15th, 2020. And the real intent here is to prohibit borrowers from creating obligations to take advantage of the program here. The last bullet is really the key to this whole program, and that's that documentation will be required for all expenditures. So I caution all of my clients to really be detailed in their record keeping specifically to this loan, and really be cautious about maintaining the records necessary to prove that they spent the money on what in fact they claim they did. So let's talk about the forgiveness limitations, because as we said, if you spend all the money on these qualified expenditures, you can have this loan completely forgiven, and best of all, it's forgiven without having to be treated as taxable income for federal income tax purposes. So they're not going to give that away without some catches. So let's talk about the catches here. the forgiveness limitations, the amount of the that's eligible for forgiveness is reduced by three things here. The first one is the average number of full-time equivalent employees per month. So you take the average per month during the 8 weeks following the date of the loan, and either the borrower gets to choose what period, what measurement period they want to use. It's either the average number of full-time employees employed between February 15th, 2019 and June 30th, 2019, or January 1st, 2020 and February 29th, 2020. So that's and if this doesn't sound like the CPA full employment bill, I don't know what does with this kind of jargon of how to figure out these forgiveness. But I didn't write it. I'm just trying to help you digest it here. But basically, what it's saying is one forgiveness limitation is maintaining the same head count from, as of June 30th that you had prior to the whole coronavirus outbreak. Okay. And so let's move on, and we'll talk about how these all interplay together. The second forgiveness caveat here, forgiveness limitation, is that the amount eligible to be forgiven is reduced by the amount of any reduction in total wages for an employee in excess of 25% of the total wages during the most recent full quarter in which the employee was employed. Again, I read that at least a dozen times to get through all the double talk there, but here's what it comes down to and what it's saying. And this is really the complicated factor for many borrowers, because it's not just a simple compare your gross wages of all of your employees before the loan to the wages that you paid during the loan, but you actually have to do an employee by employee evaluation of the wages paid before the coronavirus problems and then during this 8-week measurement period. And if that exceeds 25% of their total wages, there is a proration in the amount to be forgiven. Now, I will tell, well, let's just finish that point here. Employees earning more than $100,000 are generally excluded from this requirement. The third catch-all here is in this one was a limitation that was completely created by the Small Business Administration. It was nowhere in the actual statutes that Congress had passed. And there's a number of commentators out there that are saying that there may be some legal problems with this limitation, but the SBA said that not more than 25% of the loan forgiveness may be attributable to non-payroll costs. So if you'll remember a few slides ago, we said that the loan can be used for payroll costs, rent, mortgage payments, special interest payments, or I should say certain interest payments, things like that. And the SBA kind of tagged this third forgiveness limitation onto the other limitations. So as I started to say a couple seconds ago, these forgiveness limitations are extremely convoluted. They are in some areas questionable as to the validity, especially the last one with the non-payroll cost. But the guidance, the regulations to interpret these has not been released yet. Now, there was an update from the SBA a few days ago that said they would be providing guidance, forthcoming. I have seen a number of experts that are focused in this field really trying to take their best efforts at an analysis of what the provisions will be. Excuse me. So I have seen them take a stab at the provisions as they currently are. And I'll say right now, as the guidance or with the guidance that's available currently, it's a three-part test of forgiveness limitations. So which limitation limits the borrower the most, that will be the limitation that applies. So they'll do a limitation calculation based on headcount reduction, a limitation calculation based on payroll, and a limitation based on the the payroll cost versus non-payroll cost, and whichever one works out to the least amount being forgiven, that will be the limitation that applies. But as I said, there's new rules and there's new guidance coming out about these things all the time, and I know that's one area that's particularly unsettled. So let's talk a little bit about the actual process. So the loan forgiveness does not happen automatically. The borrower will actually need to submit an application for forgiveness to his or her bank, and it's actually going to be up to the bank to determine how much forgiveness should actually be granted. The banks are required to issue a decision within 60 days of the application. And the law specifically states, as I said before, that amounts forgiven will not be included in taxable income. So one of the things that I'll say is, please stay close to your banker when it comes to the discussions about the forgiveness provisions. Similar to the variety of rules that I've seen and processes applied at various banks in the initial loan application, I'm afraid that we're also going to see quite a variety of application of these forgiveness provisions. But one of the things that I think just across the board uh, needs to be remembered by every borrower is that um, documentation is truly going to be the key and your best friend in this whole process. So make sure that if you're using the funds for payroll, you maintain the documentation to show that the funds were used for payroll. If you're using funds for rent or other approved purposes, by all means, keep copies of the canceled checks, keep, as much documentation as you possibly can. So that is the end of my discussion on the Paycheck Protection Program loans. And now what I want to do is just spend a few minutes talking about some individual and business tax provisions. And I think these are probably the highlights that would be um, most interesting to your practices. As you may know or not know, this CARES Act was over 900 pages and included um, a lot more programs than what we're specifically talking about here. But I think these are the highlights that will help you the most. So I'm sure you've heard about the individual recovery rebates, the stimulus checks, the $1,200 per taxpayer. Basically, it's what it is. It's $1,200 per taxpayer plus $500 for each qualifying child. There's a phase out for taxpayers when their AGI exceeds 75,000, and the stimulus payments are completely phased out at 99,000. But this phase out is doubled for filers that are married filing joint, and accordingly, if a taxpayer and spouse, they would qualify for $2,400 plus any amounts for qualifying children. So one of the things that they didn't tell you about this stimulus check on the news is that this is actually 2020 tax credit, and they're using the stimulus as an advanced funding mechanism. In one of the unsettled parts about this right now is what happens if you qualify for a a stimulus check now, but then in 2020, when you figure your taxes next year, you've actually had a better year this year, and you're not entitled to the stimulus. The rules aren't clear yet whether you'll be made to repay that. Some of you may have remembered the advanced payments of tax credits that came out back in, I guess it was the 2008 stimulus program, and what a mess that ended up turning out for many taxpayers. So what I tell everybody is if you get your stimulus check, great. If you don't get your stimulus check, probably probably not lost, because when you file your 2020 return, you'll have another opportunity at that, and you know, if you qualify, you'll get it then. Now, the IRS has created a couple tools to allow taxpayers to update their information. And the first one I talk about is non-filers, so that they can submit the information they need for payment. It's also my understanding that through that system and through the next one, the Get My Payment tool, which was designed to check on the status of payments, that there's also links through those, that if a taxpayer needs to get on to change bank account routing information and direct deposit information, things like that, you can do so there. Another provision for 2020 related to the coronavirus stimulus here is that they made some changes to retirement fund withdrawals. So what they did was they eliminated the 10% early withdrawal penalty for distributions of up to $100,000. So generally, if you're below the age of 59 and a half, there's a 10% early withdrawal penalty that has been eliminated for coronavirus related distributions. Now, it gets even better, because if the funds are recontributed to your retirement plan within 3 years, they will be treated as completely non-taxable. So as I'm sure you know, with retirement funds, even if you take them out without without the early withdrawal penalty, if you're at retirement age, if you're over 59 and a half, you still have to treat those as ordinary income. For traditional retirement accounts, Roths are different. Um, but these special provisions say if you take them out for a special corona related reason, you have 3 years to repay those, and not be hit with the income tax as well. So be careful with that one, though, because there are specific rules that apply, and you'll want to make sure you talk to your tax advisor to fully understand it. The same thing with loans from qualified plans. Certain taxpayers may borrow up to his or her entire vested balance in a plan, up to $100,000. And again, that's just a change from the prior limitations. There was one thing I threw in here. It wasn't directly related to coronavirus, but it goes hand in hand with the retirement changes. But the Secure Act of 2019 raised the age for initiating required minimum distribution. So under the old rules, once you turned 70 and a half, you had to begin taking distributions out of your retirement account, whether you wanted them or not, and that age has been increased to 72. Small deduction with charitable contributions, maybe not a huge deal, but I guess it helps some of the small charities that may be getting involved in coronavirus right now. But for 2020, there is a special, what they call above the line deduction of $300 for qualified charitable contributions. So typically with a charitable contribution, it has to get filed on Schedule A, and with the recent increase in the standard deduction limits, many taxpayers were not able to take advantage of the itemized deductions. So this is a way to try to direct some funds back to the charitable organizations. And the last individual provision I want to talk about here is the employer payment of student loans. The CARES Act also expanded the scope of employer educational assistance to be able to pay up to $5,250 of principal and interest on student loans. As far as the business tax provisions go, I promise I won't beat these to death here, but I want to, bring it to your attention that there is an employee retention credit available to employers, but if you take advantage of the payroll protection program, you can't take advantage of this credit. And basically, for employers that have 100 or fewer employees, there is a credit of up to 50% of the qualified wages of each employee, and the maximum that can be used as qualified wages is $10,000. So effectively a $5,000 credit available per employee. So definitely one to watch for employers that have over 100 employees. This credit is only available for employees that you pay to be non-productive or that are not actually providing services when you're paying them. So if you're in a situation and have employees, you obviously want to take a look at it. There is some informal guidance that's been released, and the IRS also has a frequently asked questions page on its website. Hand in hand with the employee retention credit is the delay of employer payroll taxes. And basically what this provision does is it gives the employer the ability to defer the payment of the employer portion of payroll taxes. So basically the employer portion of Social Security and Medicare taxes, those can be deferred and paid in two installments. The first installment would be December 31st, 2022. That should be, should be 21. And the second should be December 31st, 22. So again, that deferment is not available for employers that are participating in the payroll protection program. And from my clients that I've talked to, they really aren't interested in the deferment. They just hate to see the bills build up and hit them later. But obviously, in a cash crunch, those things could help. A couple things: the net operating losses. I just want to make you aware of the changes. Business interest limitations. You may or may not be aware that for non-floor plan interest, and basically floor plan interest is a special type of loan for businesses that fund their inventory with debt. But there's a change in the old rules. The businesses could only deduct interest of up to 30% of their taxable income, and that's been changed for 2020 to allow them to deduct up to 50% of their taxable income. Again, kind of a very limited application, I would think, in many of your practices, but it's one that if you have debt and you've had your accountants previously limit interest deductions, be sure to talk about it and plan for it. You may have some opportunity. Another interesting part of this provision is that for 2020, businesses will be allowed to use their 2019 income for calculating the limitation. So again, be sure that your providers are abreast of these changes. Qualified improvement property. This is something that was actually, it was um, a clerical error is probably the best way to explain it. It was a clerical error a number of years ago during a tax bill, and professionals, the CPA community, the tax professionals out there have been long awaiting this technical clarification. And basically, the intent of the law was that items deemed to be qualified improvement property, which are specific types of improvements to buildings and structures, would be eligible for the special 100% bonus depreciation write-off. And through a glitch in the initial legislation drafting, this was left out, and it's been impossible to get the change made without a formal act of Congress and a formal legislative act, and they were able to do it here. And I think it's just um, good news for the business community. Also provides a retroactive correction, which doesn't happen very often in tax law, that will let taxpayers go back and change depreciation calculations, change, perhaps amend tax returns. So if you've done a significant facility renovation, if you've done the creation of a new facility, I'd strongly urge you to talk to your tax professionals and see if, under this new guidance, it may be worthwhile to look into a cost segregation study or some of the other more aggressive depreciation options to increase I should say, minimize your tax liability and increase your cash flow. The corporate AMT, the alternative minimum tax, I just want to make you aware that there was a change that allows certain corporations the faster ability to recover credits that are due them. So that's the end of my slide presentation. I want to say thank you to all of you that have joined me here today. I'm going to pull up, we got a number of good questions in the chat box. So if you'll bear with me, I'm going to try to, are we able to I'm going to try to run through it here and address as many of these as we can. So the first question with the Paycheck Protection Loan Program, the fact that it's out of money, I'm going to tell you, with the application, I am telling all of my clients to contact their bankers, and where possible, by all means today, by all means, get in line. Now, some banks actually shut down their application process and said they would not accept any more applications, and other ones, are still taking them and putting in the queue. So it's definitely a bank by bank decision, but I would highly advise you to stay with it in hopes that this opens back up. I got a note from someone here that David actually filed today and got his confirmation of acceptance. That's amazing. I'm not sure what bank you're working with, but that's absolutely terrific. Typically, what I've seen with my clients is the application goes through the bank. The bank has an internal review process. They approve or come back to the client for more information and so forth. And then they send it on to the SBA, and then the SBA approves it. So I've not seen any of them turned around in one day. So that's fantastic work by you, your advisors, and in your bank to get that thing done. Wendy actually has a question here about should we have applied to our bank versus the SBA website for our loan, or should we have done both? I applied through the website and not the bank where my business resides. Okay, so here's the deal, and there was a lot of confusion out there on this one, Wendy. So what happened was the SBA announced that this thing was ready to go, they put that big flashing yellow banner at the top of their website and said, coronavirus relief, here's the place to apply for it. And when they did so, they didn't um, they didn't tell everybody that what you were applying for there was the EIDL loan, the economic injury and disaster loan. Okay, so that's the one that's the 3.75% loan. It does have a $10,000 emergency grant that can happen, but that's the one that's more of a traditional disaster loan. And so if you applied through there, that's what you applied for. The Paycheck Protection Program has to be applied through your bank. There is a simple two-page application, but and I believe it's from the Treasury Department. But anyhow, it, the process has to go through your bank. So the good news is, if you applied through the SBA and are in line for an EIDL loan, if that comes through, that can help you. It's not as beneficial or as exciting as the Paycheck Protection Loan, but it's still funds to help your business. Now, should the Paycheck Protection Loan open back up and you're able to get in that program, the great news is that you can take that economic injury disaster loan and literally roll that into or refinance it in your paycheck protection loan. So you didn't do anything at all to harm yourself. And it's not bad. I have a number of clients that tried to do the same thing, where they tried to apply for both loans and just hope to see which one comes through, or perhaps both of them come through. So you definitely did not hurt yourself at all. Let me take a look at this next one. Okay, so on this one, and I'm sorry, this was a long question here, but it's definitely worth talking about here. So the first question is, whenever you calculate the paycheck protection loan, is it based on solely the payroll, or is it the payroll and payments made to contractors on 1099s? And this was a huge area of confusion and conflicting. Even the banks I talked to, up until very recently, you would get mixed messages from them on this issue. And the amount that's eligible for the paycheck protection loan is strictly the payroll paid out. So owners' distributions from a subchapter S corporation don't count. Payments to 1099 contractors don't count. So it really is based on just the payroll, health insurance costs that are funded by the company, retirement plan benefits that are funded by the company. Also with this, a question about the EIDL grants that also ran dry. Now, my understanding was that the EIDL grants were a temporary hold in the process, and they were going to process the applications through and get back in. So I don't have anything further on that, because quite frankly, my client base is definitely much more interested in the paycheck protection loans, but definitely something to watch. The information will be right out there on the SBA website. You mentioned also in the question, the question was, with the EIDL program, is any of this forgivable? as it is under the Paycheck Protection Program. Well, there is a potential grant of up to $10,000. The EIDL loans do not have any forgiveness provisions like the Paycheck Protection Program does, but they do have a potential for a $10,000 grant. And the final question here was, do you disqualify yourself from being able to qualify for an EIDL loan if you have other means to pay? Unfortunately, you typically do, but I'm going to tell you to apply anyhow. I think that what the SBA is doing and what the government has directed the SBA to do is to try to get as much money into the economy as possible. And it's my understanding that although those requirements, that if you have other sources of funds available, it typically disqualifies you from this type of loan. And I shouldn't say this type of loan, but this is a typical 7A, what they call a 7A loan. And typically other sources of funds disqualify you from that. But I believe in this case with the coronavirus and the government's intent that you will have some opportunity. And okay, I'm not sure. I think everybody's still here. I got a message that my presentation might have timed out here. I am just going to finish up in just a couple seconds with a couple quick questions. But if you are still there, terrific. If you're not, I'm sorry I lost you. Not a long question. Right? Encouraged to discuss my lease with my landlord. Other tenants might want to. Yeah. So okay. So lease rent abatement. Yeah, absolutely. I'm telling all of my clients to discuss their lease agreements with their landlords. Quite frankly, there's no downside to talking to them. And there are landlords, and unfortunately they're in the same boat as all of the business owners as well. There hasn't been a special program yet aimed at landlords. Now there is discussion that residential landlords are going to have a special program for lease abatement and things like that for residents, but I'm advising everybody to, yes, definitely talk to your landlords. A lot of them are willing to work with you, and what are they going to do if you can't pay the lease? Are they going to throw you out and try to find somebody else to put in your space during this coronavirus time? So I hope that's helpful. If you pay payroll only on yourself, can you qualify for paycheck protection loan? Yeah, absolutely. And I shouldn't say absolutely to anything, but I have not seen any guidance, to the contrary there. So if you have payroll, you can qualify for the paycheck protection loan. So yeah, definitely something to look at. Okay, and fantastic. We still got people here, so I didn't lose you guys, and that's terrific. Do you disqualify for an EIDL if you've applied for unemployment? I know that's true for the PPP, but wasn't sure about the EIDL. Okay, so with the unemployment, I got to be honest with you, I have not run into that question with disqualification from an EIDL loan. So what I would advise you is, by all means, throw the application in, try to get it try to get it handled here, and move forward with it. But I have not seen that as a disqualifying item. Okay, so here's actually a really good question from Daniel, and he says, follow up on the last question. Are you still eligible for PPP if you're a solo LLC, who has not done 1099 forms or similar when paying yourself, your sole employee. Okay, it's my understanding that you are. Now, I'm going to say that with one caveat. If you are a solo LLC that's made an election to be taxed as an S corporation, you might have a problem there. But if you're a solo LLC, um, paying taxes as a sole proprietorship, then you would be paying self-employment income. And it's my understanding that your paycheck protection loan amounts would be directed on or would be based on the amount of your self-employment income. So I think I think that actually hits it. I think I've covered, there's a few questions here that go right along with the questions we answered here, but I think we've covered everything. I want to thank everybody for staying with us here. I know that accounting and tax topics, aren't exactly the most exciting things out there to sit on a CPE or a continuing education program at 6:30 on a Thursday night. But hey, thank you guys very, very much. And it was an honor to be here and a pleasure to be with you. I wish you all the best in making it through this, and hope you all do fantastic. So with that, I am going to I'm going to sign out of the program here. And again, thank you. You know what? I did get one last question that I have to address. I'm sorry, but the question came up. Am I accepting new tax clients? And yes, we are. I'd be happy to talk to anyone. I'd advise you that the best way to reach me right now would be to start out with an email, and I'll be in touch with you, and we can obviously go from there. But thank you all very, very much. It was truly a pleasure to be with you. And like I said, if you have any questions, please feel free to email me. All right. Thank you guys. Take care.